To keep yourself updated, subscribe to Indigolearn and click the bell icon and download our app OneFin to start learning on the go.
IPL Limited uses a small casting in one of its finished products. The castings are purchased from a foundry. IPL Limited purchases 54,000 castings per year at a cost of rupees 800 per casting. The castings are used evenly throughout the year in the production process on a 360 days per year basis. The company estimates that it costs rupees 9,000 to place a single purchase order and about rupees 300 to carry one casting in inventory for a year. So the ordering cost is rupees 9,000 per order, the carrying cost per unit per annum is rupees 300. The high carrying costs result from the need to keep the castings in a carefully controlled temperature and humidity conditions and from the high cost of insurance. Delivery from the foundry generally takes 6 days, but it can take as much as 10 days. So what they are saying is, normally if you place an order today, in 6 days you get the order. So the average lead time is 6 days. But there can be circumstances where it can take up to 10 days. Alright. The days of delivery time and the percentage of their occurrence is shown in the following tabulation. So they have given us the delivery time in days. So 6, 7, 8, 9, 10 and the percentage of occurrence. So probably they are trying to indicate the probability. So there is a 75% chance that the delivery will be made in 6 days. There is a 10% chance that it will be made in 7 days. There is a 5% chance in 8 days, 5% chance in 9 and in 10 days respectively. Alright, see what will happen. Let's say if I am keeping a stock only of 6 days as the safety stock, and if the material is coming on the 6th day, then no problem. But if the material comes on the 7th day, what will happen? Sir, you kept a safety stock of only 6 days, you will finish that stock in 6 days, one day what will you do? You will go stock out. So that means, please understand this very carefully. If I am saying that there is a 75% chance of material being received in 6 days, that means if I am placing an order based on the 6 days delivery time and if I am keeping average stock only of 6 days, there is a 75% chance that we will get the material in 6 days and we will not go stock out. But at the same time, there is a 25% chance. From where did I get this 25%? 100 minus 75. There is a 25% chance of going stock out if you keep stock only for 6 days. Sir, I cannot afford to take 25% risk. I want to reduce the chances of stock out. Then keep more stock in inventory as buffer. Maybe keep for 7 days. What will happen if you keep safety stock for 7 days? Alright, there is a 75% chance that you will get it in 6 days, additional 10% chance that you will get it in 7 days. So cumulatively, there is a 85% chance that you get the material in 7 days. That means there is a 85% probability of not going stock out, 15% probability of going stock out. Not comfortable with that? Increase it further. Keep safety stock for 8 days. So your probability of not going stock out further improves by 5%. Now there is a 90% chance you will not go stock out, 10% chance that there will be stock out. Alright, so you keep increasing the number of days. If you want to be 100% sure, if you don't want to take any risk at all of going stock out, keep the safety stock for 10 days. Find out what is the average consumption per day. Keep that average consumption per day stock into 10 days as safety stock and run your business. So you will never go stock out. So it depends upon the risk that you are willing to take. Alright. Required, compute the economic order quantity. Very simple and straightforward. Economic order quantity, we will use our formula which is under root 2 AO by C. A is the annual demand which is 54,000 castings per year. O is the ordering cost per order which is given as 9,000 and C is the carrying cost per unit per annum 300. So we will apply that formula, we will find out what is the economic order quantity. Second, assume the company is willing to assume a 15% risk of being stock out. So how much risk they are willing to take? 15%. That means they want to be sure by 85% that they are not going to become stock out. Where will we achieve that 85%? For 6 days, 75%. If I increase by one more day, if I go to 7 days, my percentage will increase by 10%. So 75 plus 10, total 85% chance of not going stock out, 15% risk of stock out which they are willing to take. So that means they are indicating they will keep a safety stock of 7 days. What should be the safety stock? So safety stock should be maintained for 7 days, and the reorder point should be basically safety stock plus whatever is your reorder quantity EOQ. Next, assume the company is willing to assume a 5% risk of being stock out. They cannot take 15% risk, they want to reduce the risk further. So increase the number of days, increase it by one more day. So 85 becomes 90% chance of getting the delivery, 10% stock out. Increase it further to 9 days. 95% chance of getting the material, 5% risk of stock out. So maintain the safety stock for 9 days. Fourth, assume 5% stock out risk. So assume that they keep safety stock for 9 days. What would be the total cost of ordering and carrying the inventory for the year? So you calculate the total ordering cost, which will basically be number of orders into the cost per order, and when it comes to carrying cost, you will have carrying cost for the EOQ, plus we will also have to carry some safety stock for 9 days. So what will be the carrying cost for that safety stock? So both we will have to compute. Fifth, refer to the original data. Assume that using process re-engineering, the company reduces its cost of placing order to only rupees 600. In addition, company estimates that when the waste and inefficiency caused by inventories are considered, the true cost of carrying a unit of a stock is rupees 720 per year. Compute the new EOQ. So what will be the new EOQ? Second, how frequently would the company be placing an order as compared to the old purchasing policy? So previously in how many days we were placing order, now in how many days we are placing order, how frequently we are placing the order. So that recomputation will have to be done. So looks to be a simple straightforward question. The only trick part here is understanding the concept of the risk that we are willing to take. So depending upon the risk that we are willing to take, safety stock has to be computed. So that safety stock plus whatever reorder point or the reorder quantity. Let's look at the solution. Friends, let's start off with a small working where we indicate the probability table, and we indicate for each of the number of days what is the probability of going stock out. That will help us in answering bits 2 and 3. Working note number 1. Probability table. Number of days, percentage of occurrence, cumulative percentage, or basically probability of getting stock, and then this will be probability of stock out. So 1 minus cumulative percentage. So 6, 7, 8, 9, 10, 75%, 10%, 5, 5, 5. Cumulative will be 75, 85, 90, 95, 100. Probability of going stock out 25, 15, 10, 5, 0. So if someone is willing to take 5% risk, they have to keep 9 days safety stock. If someone is willing for 10% risk, they have to keep 8% stock, 8 days of safety stock. Alright, now let's go to the requirements in the question. So first one, computation of EOQ. EOQ is equals to under root 2AO by C, where A is the annual demand, which is given as 54,000 castings. O is the ordering cost, which is given as rupees 9,000 per order. C is the carrying cost per unit per annum, which is given as rupees 300. Therefore, EOQ is equals to under root 2 into 54,000 into 9,000 by 300. So we get 1800 castings. Bit number 2. Safety stock at 15% risk. So basically we will calculate based on 7 days. So safety stock is nothing but average consumption into maximum lead time minus average lead time. So normally it comes in 6 days. We are wanting safety up to 7 days. So that 1 day extra stock we will keep. So 1 day extra equivalent consumption stock is going to be our safety stock. So what is average consumption? They are saying the annual demand is 54,000 units and you consider a 360 days year. So 54,000 by 360, which is 150 per day. This is the average consumption. Therefore, safety stock is equals to 150 into 7 minus 6, which is 150 castings. Then reorder level or point will be your safety stock plus average lead time consumption, which is nothing but 150 plus 6 into 150, because average it takes 6 days. So 1050. So this is basically what we were discussing while reading the question. So if you want to take only 15% chance, ensure that when you are placing the order you have 7 days of stock. So 7 days of stock is nothing but 7 into 150, 1050. If I break up that 7 days of stock, 150 units is your safety stock, because that additionally we are building in as a buffer, and rest 6 days is your normal consumption, the average lead time consumption. Bit number 3. Safety stock assuming 5% risk. So we will have to go with 9 days. So therefore safety stock will be average daily consumption into max lead time minus average lead time. So that will be 150, which we computed earlier, into 9 minus 6. So typically 3 days of extra inventory we are keeping as safety stock. So this will be 450 castings. And reorder level will be safety stock plus average lead time consumption. Basically 9 days worth of stock we will have to keep. So when we reach that, we will have to do the reorder, which will be 450 plus 6 into 150. So that comes to 1350 castings. Bit number 4. They are asking what is the ordering cost and carrying cost, assuming 5% risk of stock out. Ordering cost is equals to number of orders into order cost, or basically cost per order. So how many orders will we place? We need 54,000 units annually, and every time we place an order, the EOQ is 1800 units. So that will give us the number of orders into 9,000 is the cost per order. So it comes to rupees 2,70,000. And as far as the carrying cost is concerned, at EOQ or for EOQ, it will be 1/2 into EOQ into cost per unit per annum plus for safety stock. We will be keeping 450 units always with us throughout the year into cost per unit per annum. So basically this will be 1800 is our EOQ by 2 into 300 is the cost per unit per annum. This will be the carrying cost of the economic order quantity, plus for the buffer that we want to maintain, we will be spending 450 into 300 extra. So that will be 1800 by 2 into 300, 2,70,000 plus 450 into 300, 1,35,000. Totally put together 4,05,000. Friends, another way of looking at it is how much is the stock on an average we will have throughout the year at any given point of time. So the stock 450 units definitely we will have, and we will have half of EOQ. At some points it will be 0, at some points we will have maximum because we will be using it continuously. So that is why we take half of EOQ. So the number of units that will be there on an average with us throughout the year is going to be 450 units of safety stock plus half of 1800, that is 900 units of EOQ. So totally 900 plus 450, 1350 units will be there with us on an average, and 1350 into 300 per unit, you will get directly 4,05,000. So you can do it in whichever way you are comfortable. Then last bit, revised EOQ. So the revised EOQ is going to be 2 into 54,000, which is our annual requirement, into what is the revised ordering cost? It is 600, and the carrying cost is rupees 720 per unit per annum. So 2 into 54,000 into 600 divided by 720, we get 300 castings as the revised economic order quantity. And in second bit they are asking what is the change in the frequency. So frequency of ordering before, after. Annual requirement 54,000, that has not changed. EOQ will be 1800 before, 300 after. Therefore, number of orders, earlier we were to place only 54 by 1800, 30 orders. Now we will be placing 54,000 divided by 300, 180 orders. So if we were to talk about frequency, earlier we were placing one order every 12 days. Now we will be placing one order every 2 days. So from 12 days to 2 days, that is the change in the frequency that has happened.